They're not making it easy out there. We've seen some pretty nasty overshoots and, more importantly, some sporadic OPEX reclaims on Friday. It's a shortened Christmas trading week upcoming that honestly might be set up to rally very similarly to Thanksgiving's shortened week, and it has everything to do with a specific failure pattern, which we'll talk about. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 6 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off in the SPY weekly time frame talking about candle structure and location as we always do. In terms of structure, we've got ourselves a red-bodied hammer candle here, which is pretty impressive. As we know, sell-side pressure develops the lower wick, but buyers respond and they are able to close in the midpoint of the weekly range. Now, the close is actually more important than just the midpoint of the weekly range, because if we segue into bar-to-bar count, you can clearly see that the lower wick does produce a substantial lower low on the bar-to-bar count. It's actually a brand new 2-week low. Remember that these were equal back here. So new 2-week low, buyers respond, sellers can't accept price down there on those lows, and once again the close is in the midpoint of the weekly range, but back inside of the 2-week balance range here. So do we have stronger sellers based on the weekly structure? I would argue no. Now, do we have overwhelming buyers? Probably not, because the red-bodied bar would suggest that the opening print is still, of course, over the closing print. Buyers couldn't retake the open and expand range in the upward direction, of course. So we've segued a little bit into location, but we do have to admit that, of course, there is a lower high on the bar-to-bar count as well. It's not rainbows and butterflies. If we did get a green-bodied close, maybe we had a bullish engulfer here, but that's just not the case. So dealing with the chart in front of us, I really like the weekly hammer here, suggesting the opportunity for a higher low. As we know, this is a weekly firm higher low because from the pullback from the all-time high to this low, the 20 SMA on the weekly time scale, the daily trend did flip to down. We did not get a daily downtrend in this bar, so this would be a soft higher low, but coming back up into these equal highs, what should be the natural evolution of an uptrend after forming a higher low here? We should likely go on to produce a higher high. That's the definition of an uptrend, higher highs and higher lows. Now, the contrarian would say, no, this is still a weekly equilibrium, a bit more bearish. I'm not personally, but I'm saying a contrarian might say that. Equilibrium, in which case, okay, you're neutral in this range. You're not even bearish. If you're starting to suggest that this is a double top, remember that you actually have to break the neckline, which is 654, and bring in a lower low to trigger that pattern. Until that actually happens, I can't maintain any sort of bearish stance here, or I can't even develop any sort of bearish stance here on the SPY weekly timescale. It would really require some sort of look above and fail over the span of the next few weeks if that pattern is going to develop as a short from the high after failing to go higher. But again, we're sort of like speculating at this point. Given the chart in front of us right now, this hammer candle strikes me as being constructive for the buyers seeking some sort of pressure at the all-time high, potentially into this shortened holiday trading week. Do the Fibonacci's agree with this perspective? I would say yes. All of this consolidation has still taken place well above a Fib 38.2. We described how all of this is over the weekly 20 SMA in orange. If we come in here with the anchored VWAPs on the SPY weekly, you'll even notice that the lower wick punctures 2 of the anchored VWAPs, but yet where do we close? Back above the entirety of the stack. There's really nothing bearish to say about that. What about the volume profile on the weekly perspective? Let's zoom out here and let's take this down. The highest volume node is still being used as, I mean, we didn't even really test it, but we're over that. The higher low is above it, so that's bullish. You can see here if we extend this one off to the right, we've closed right at this high volume node. So if we're going to use this as a constructive launch pad, ideally you just stay over this high volume node, which would keep the weekly equilibrium in play and some sort of higher low, or you break away from the highest volume node that we have up here near the all-time high into blue sky territories and inherently bring in a higher high in the weekly trend count. So no matter how I slice it here on the weekly, I do lean a little bit more bullish than bearish. Let's take a peek over at the daily time scale. And the first thing we'll evaluate is this week's expected move. If you're not familiar with the expected move, check out the video tutorial in the top right-hand corner. Of course, on a shortened holiday trading week, it's going to be a little bit smaller, and of course, it's literally shorter. But the upper bound is going to be at 687.78, implying a slightly lower high from the all-time high, equal high that's going on over here. If we're contained by the lower bound, it's 673.40, which is a slightly higher low relative to the Wednesday breakdown from last week. So I would argue that expected move is probably just neutral headed into a shortened week. But if you recall, we smashed the upper edge of the expected move during the Thanksgiving rally, which kind of is a nice segue into this failure pattern that I think is somewhat fractal here when we compare the two. Remember that this large bearish engulfer from 1220 was followed up, so that was a Thursday. Friday we followed up, swept the low, and then closed inside that range, basically indicating that sellers were unable to take prices lower underneath that major inflection point, which was the same equal low from the October 10th bearish engulfer, right? So that failure pattern, in my view, really led to the market being able to squeeze back in the upward direction on a light volume shortened holiday trading week. Now, if you look at what we have currently, here's the large breakdown on Wednesday, and then here's the failure to go lower on the Thursday session in particular. The reason why that, in my view, is such a big failure for the sellers is because you actually produced resistance at the lower bound of the upper range here in that upper wick from Thursday's session. Let's go down to the hourly. We'll sort of bounce back and forth between the two. You rallied, found resistance, and then sold off a little bit back down towards these lows for a close as that daily bearish inverted hammer, right? You closed underneath the opening print. So all it would have taken was on the Friday session, the sellers to take price underneath 675 and retarget this low here, and suddenly we're just producing a high and a lower high. But what actually happened on the Friday session? Where did we close? We closed well over, of course, the Tuesday and then thus Thursday low. And we also closed over the bottom end of this previous overhead supply. We closed over 679.75. So in my view, it's not an undercut like what we had here on that Friday session, but it is still a failure of the sellers to materialize on the one little bit of momentum that finally started to spark in the market. Sellers failed to materialize on that, and you could see the nuanced hold there. Tuesday's low becomes the same low as Thursday. If we had stronger sellers, they should have taken that with momentum, Brigade bolt underneath on that hourly, equal low to the Wednesday low, and it just didn't happen. And once again, even on the Friday follow-up, you open underneath the daily 20 SMA, the orange moving average on the screen, and yet sellers can't keep prices underneath for the close. This is what I mentioned in the intro, a sporadic OPEX reclaim. Yes, it was OPEX. Yes, there was a lot of money expiring there and potentially new positions being put on. But if we just take this chart at face value, this is ultimately a failure of sellers to materialize from a breakdown from the overhead balance range. You could start to see how, again, it was a pretty nasty overshoot here at this key area, but it started to step up firmly on that Thursday session, and we closed away from it on Friday. Thus, if this is a similar failure pattern to what we had on the 1120 bar and then the Thanksgiving rally, it's very possible that with light volume, not a lot of people at the desk, people just sort of stepping away, the algos, of course, will always trade, but any acceptance over 679.75, and I do believe it's possible to go back to the all-time high and overshoot the upper bound of the weekly expected move this shortened Christmas trading week. That, in my view, is the daily thesis here. Sellers had everything going for them on Wednesday, and they just couldn't get the job done. Now, I know we've also been talking about AI leadership here around the channel recently, and there are still concerns out there, but I just want to point this out because it does strike me as noteworthy. In all of the other AI earnings configurations, we saw a gap up that faded aggressively. MU did that on the first day post-earnings. But what did it do on Friday on the follow-up from earnings? It actually rallied, it took out the Thursday high, and it closed at a brand new all-time high. Now, I'm not, saying this to say, oh my goodness, markets just have to be up. It's like MU's going to save the day. But what I am saying is that this is different from what we've seen recently in a lot of these AI-related trends, right? If we go to NVIDIA, this was perhaps the poster child of this. There's your gap up, and it's been brutalized ever since. Right? So MU is starting to say something slightly different. Now, of course, if you think about how the money flows in the AI ecosystem, so to speak, you need funding, and then you go to data centers. So we'll say DC for something like your Oracle, your NBIS, your IREN, all those things. DC is data center. And then you go to chips, right? That's going to be your chip designers like NVIDIA. And then that money, of course, goes over to the foundries, the fabs, all of that stuff, MU being, of course, a component of memory. So you could say it's pretty late here in the ultimate value chain, if you will, of AI, but nonetheless, it's still a AI-related company that's performing well for the AI narrative. We'll continue to have to see if basically OpenAI, who hinges upon all of the funding, if they are going to come through with these trillions and trillions of dollars of projected revenue. But back to the charts in front of us right here. Let's get on down to the hourly chart here for the S&P 500, there's a couple of things to point out as a nuance. Let's come in here from the top down to the low of that Wednesday session. We're between a rock and a hard place, right? We are ultimately between the fib 38.2 and the 68.1. However, what I would say is that the 50% mark is an easy visual, right? Just to get visuals there. If the sellers are going to keep a stronger edge in the market, typically you don't want to see more than a 50% retracement, right? And as you can see, it is that same exact level right here, the bottom end of the previous balance happening over here, which has been recaptured into the end of Friday's session. So early on this upcoming week, I think it's very clear, right? And this was one of the back pocket situations we drew up on Wednesday. It's very clear that any acceptance over 679.75 with a bullish twist, maybe on the AI narrative and a more accommodative Fed, as we know, those are the two main themes that have been keeping the market higher. If that's the case, holds over 679.75 should at least seek some sort of mean reversion here, midpoint of the range, but more specifically, like the all-time high is a reasonable target. Right? If you are going to hold this, if this is going to be a little bit of a sloppy, but still there, daily high or low, the hourly trend has started to flip to up with lows, higher lows. Any higher low acceptance over 679.75 is not only just a higher low, but it's a higher high. Right? From here to here, it's very nuanced, but it is technically a higher high. So as the hourly trend flips back to up, any consolidation over that 679.75 should put the pressure on back towards the all-time high. Midpoint of the range, certainly mean reversion is going to be a target in here, 682.80, 684.50. Those are reasonable levels to have. However, the main target is 689, all-time high, which then from there, as we talked about on the weekly chart, potentially looking at an all-time high breakout to bring in a higher high in that weekly trend configuration. What if we come in with a Fibonacci? We've already got it loaded from the low up to the high. Notice that it was a quick overshoot, one daily close under the fib 38.2, but then Thursday's consolidation puts us back over the fib 38.2. So this level, it's been a little bit tricky to navigate. I would say a couple of things really step out or stand out as being the saving grace of the market into the end of the week. Number one was Thursday's open above 675. If we opened underneath, I think we're talking about a completely different chart with more sell side pressure. And then number two is Friday's end of day rally. The fact that we close over 679.75, once again, just illustrating that we don't have stronger sellers here. If we did, they should have capitalized on this move here underneath the daily 50 SMA to offer more downside pressure, lower high here, ultimately rotating into some of these lower targets. It didn't happen, and 679.75 is the key walking forward. Let's come in here with our intraday anchored view apps just to see where we are in the stack. We're pretty much tangled in the stack. So as we think about this chart, and as we say in the intro, they haven't made it easy. When I say they, I'm just talking about markets. There is no us, them, they, whatever in the market. You know, hedge funds, algos, you could think they're out to get you. They're not. They don't care about you and your, even if you have $1 million account, I promise they don't care. So in the anchored view app stack, is it expected to be easy? No, of course not. You have too many reference points to battle through. As we start to navigate out of this, right, is it possible that as we lift over the final anchored view app band, we start to get that rotation? Absolutely. That is the start of this from back here. The anchored view app that's keeping us suppressed so far is the start of the consolidation. If we can clear that, then guess what? All of the buyers, not all literally, but most average weighted volume buyer starts to feel happy about their potential position, and thus maybe they add to it, right? It's easier to get long there. Or just flip the script. How do the sellers feel? Sellers, of course, feel a little bit more like that. And they're like, "Ooh, we might have to stop out of this thing," right? It's not going down. Why is it not going down? Shaking their fist at the air, right? So clearing the anchored view app stack should be a little bit more of a bullish indication, trying to lift towards that all-time high. And as of right now, once again, see the close happening here. Why were sellers unable to materialize on a close outside of the entire anchored view app stack? If stronger sellers were going to show up, this was the time to do it, and they have completely failed. I'm willing to keep an open mind, but what does our simplified pathing ultimately look like? Let's go back to this, and let's just take a look. Consolidation, upside lift, as we know, to the all-time high. If we fall back down over here, not the worst thing in the world. Let's try that one more time. No lapses in the mouse. There we go. If we fall back down into here, not the worst thing in the world, I would still keep an open mind for this, right? It's really all about the recapture, as we've been saying, reclaim, recapture. 679.75. Where problems start to emerge is if, yes, the market does this, and we start to find lower high acceptance under 675. Again, sellers had their chance. They had TG, capital T, capital G, the gift. Sellers had the gift. They sort of failed, right? Just like buyers had the gift on that Wednesday open, buyers failed. Well, sellers failed in a more meaningful way. in my opinion here, with just such a prompt snapback in the upward direction. So these are sort of like the main zones that I'll be thinking about this upcoming week, 679.75 and 675 flat. If we're in between those two zones, neutral and open-minded. If we're above, bullish up here. If we're below, bearish down here with downside targets, as we can see. That's what I've got for you on the spiders, on the actual analysis of the candle charts. Let's take a look through some supporting evidence, though, and see what else we can glean. If you're not familiar with the market internals, this is always the first pit stop. Check out the video tutorial in the top right-hand corner. How are the volume flows? What we really care about is the OPEX session on Friday. That was the day where I would say the buyers really started to step up, and that's what caused the lower wick on the weekly timescale, right? That weekly hammer we've just explored. So what was going on Friday? Strong buyers, I mean, not overwhelmingly strong, up and over 300 million, but still closing fairly positive here. If we look at the advanced decline line, much more neutral, much more muted. Intraday, okay strength, just a hair shy of double digits positive most of the session, and the cumulative build a little bit more so to the downside. So as I think about this in its general configuration, this might neutralize the analysis just a little bit, right? We might go back over the chart here and say something like, if you get this failure, you could attempt, it wouldn't be, I probably will not participate in this trade, but A to B, you could attempt a lower high, generally speaking, from here to here, and the buyers just got a little bit of an OPEX overshoot, but it's just going to be exactly that, right? Just like we had overshoot here, you could say overshoot up here. So there's some real-time, like attitude adjustment, if you will, about the strength of the buyers, noting that on Friday, it wasn't as, it's not rainbows and butterflies. Now, I will just sort of skip ahead a little bit and let you in on a little secret in case you never make it to this point. If you check in on the NASDAQ market internals, which we know NASDAQ tech is like 30% plus of the S&P 500, strong volume inflows, better advanced decline line, bullish cumulative build on the tick. Okay, so I've done my homework, right? And the point being is I probably still have a little bit more of a bullish tone on the market, but just looking at the NYSE internals at face value, yeah, if you wanted to be a little bit more open-minded to neutrality in here between the rock and a hard place, 679.75, 675, be my guest, but I think that tech is sort of telling the story. So let's just complete the S&P analysis with the market profile, then we'll jump into the NASDAQ itself. You can see value here, and by the way, if you're not familiar with market profile, video tutorial top right-hand corner, as always. So value on Thursday and Friday are clearly higher than that of Wednesday. So once again, if Wednesday was going to be the big breakdown day of sellers where, oh my goodness, we're going to run away with this and it's going to be just down, 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 you need to see value at least overlapping sideways, if not continuing in the downward direction. Point of control migrates higher. Value is, certainly overlapping to up as it is on the Friday session. Super clean value to the upside, breakaway point of control, and actually a poor high as well. So this GHK period, straight across the top, flat there, is the improper end of the auction. I would expect that to be repaired, which would inherently mean some sort of break in the upward direction. Here's another really nuanced take for you on the market profile. We had single prints on the Wednesday period, did we not? C period back over here. If we had stronger sellers, what ideally would have happened? You would have gotten a rejection where you basically looked like this. The most bearish thing, right, would have been opening in the lower distribution here. That didn't happen. But then from there, you could have gotten an opening drive, acceptance under the single prints. That would have been fairly bearish. Or opening drive, rebound, reject the single print high, and then close somewhere down here inside of that value area. None of that happened, right? Value was actually, overlapping straight into the single prints. Value did not build out underneath those singles. So if value was like completely contained here, that might be a slightly different story underneath the top end of the range there. It just didn't happen. Once again, the point of the exercise is to say what types of participants are getting involved in this market. This is less about new money sellers. To me, it might just seem like late longs if we just think about this narrative. Anybody who was long late to the party up here finally throws in the towel and says, geez, got to stop out of it. I just can't continue to hold this underneath the daily 20 anymore. It's long stopping out. It's not new money sellers, momentum sellers stepping up in the market and saying, oh my goodness, markets deserve to crash and burn and go to zero. We need to flip into a downtrend. So that's the main take here on the Spiders Cash. That's the analysis of the S&P. Let's reset this and let's take a look over at the NASDAQ. We've already looked at the market internals, so I'm sure we could start to assume a couple of things here, right? Very similar in terms of your weekly structure. It's a hammer candle. You still have a red-bodied bar, but notice how much smaller the body of the bar there is. The buyers did a really excellent job of not just closing in the upper 50%, but really like the upper fifth, upper fourth of the weekly range here. Very impressive rebound off the lows from those as buyers, which to me is a more bullish indication. We're still in weekly equilibrium on the NASDAQ, noting that this is a lower high and this is a potential higher low. So as of right now, it's a little bit harder to maintain that higher time frame bullish stance when really you're just battling with range compression. Right? You could make an argument that you could bring in some trend lines like that, and until the triangle breaks, you don't really know what's next. And that's a fair point, right? That is a fair point. I would still maintain the stance on the Qs weekly that you would need to break down underneath the last major higher low, which is in here around that 588s. If you break that for a lower low, sure, I'll flip my stance. I'll get a little bit more bearish here. We'll start talking about, maybe it's even, dare I say, it's a Man Ray pattern on the weekly. And I'm not trying to be, speculative in terms of that it needs to happen this way. I'm just saying if we break that 588, then fine. We'll have a lower low and we'll have some sort of lower high double top on the weekly. We're not quite there yet. Let me just check in on that daily the weekly 20 SMA. Yeah, perfect support right off of the weekly 20 SMA happening here. That looks pretty darn good. If we check in with the Fibonacci's, of course, over the entirety of the stack still, that makes sense. And we'll come in with the anchored VWAPs on the weekly, closing above them all after puncturing and piercing down into them. Once again, buyers probably have a little bit more of an edge here. Let's take a look at the volume profile just to be congruent in the entire analysis, and we'll see what's going on from this perspective. If we do that, high volume node, is acting as the lower wick. There we go, low. The lower wick of the weekly bar. That makes sense. And really to the upside, you don't have a ton of high volume nodes above to be concerned with. This high volume little peak right here is kind of right where we closed. Then maybe if we take that off and take a look at this high-ish volume area, that's just going to be your weekly high. So if you could break that weekly high, I would just be bullish on the move over that, which we could probably see with more clarity on the daily. So let's just go there now. Qs, please. There we go. Right, that would make a lot of sense. If you just take this out, then of course the look is this for the all-time high. It's fairly straightforward. But before we get ahead of ourselves, let's start with the expected move. Once again, shortened holiday week, compressed range, the whole 9 yards. The upper bound is at 625.33, which is slightly a lower high, underneath the previous pivot. Not the end of the world, but still in range compression. If we look at the lower bound, it's going to be at 608.77. That would be a higher low relative to the Wednesday breakdown. So in my view, kind of set up similar to the S&P 500 where expected move might be a little bit more neutral. In this situation, though, look at how much more severe the recapture is of the top end of these 3-day highs. Right? Take a look at this solid green-bodied bar, which is why you get that more exaggerated lower wick on the NASDAQ weekly versus the S&P. Take a look at that bar, and then just go back over to the SPY and take a look at this, right? It's more of an equal high relative to these prior three right there. So the point of the exercise is to say that the NASDAQ reclaim here, which again, reminder, is 30, I think it's more than like 35% these days of the S&P 500, the XLK is. This recapture of the daily 50, the daily 20, the close over these three equal highs after the sellers really failed underneath the 606. We've updated to 607.50, the low of Tuesday and the low of Thursday, but it was 606, so just don't split hairs with me too much. It was slightly lower. Big failure from the sellers to accelerate underneath. No lower high underneath the level, no rotation here, nothing. Nothing. Sellers completely failing to do anything with that momentum from Wednesday. And once again, think about how that might be similar to what we had from 11/20 in a fractal sense, right? After a failure pattern headed into a shortened low volume, low liquidity week, wouldn't be unreasonable for some lift here to the top of this, an overshoot of the upper edge of the weekly expected move to make an equal high closer to that 630 mark, which mind you, there's still an unfilled gap there. Now, I will have to give a little bit of credit, a little bit of respect to the sellers here because technically speaking, we did not puncture up and into the overhead supply here. We still have 618.50 to contend with as a potential area of resistance, and therefore, I think the main levels that you need to pay attention to on the NASDAQ this week are simply 613 and 618.50. That's it. If you're in between, buyers are making a stand, I would maintain a bullish stance, and I would get really bullish if we can recapture, there's that word again, over 618.50. If we can do that, your equal high target is up there at 629.20. The gap closes 629.75. 630 is the round figure. So still bullish on this consolidation here because we're holding over the multi-day high as well as the moving average stack, the 50 SMA most importantly, the blue moving average on the screen. If we lose 613 and the low of Friday, that's where concerns start to emerge. Here I would start to become bearish and I would actively seek shorts on the market underneath something like 607.50, which as we can see on the hourly chart would just be a failure of the shoulders of the head and shoulders pattern. So here it is. Right, there's the inverted head and shoulders. Great, fantastic. Here's your neckline. You already broke out. Versus the S&P, it's very, very nuanced. It's trying to break out. It's not all the way there yet. Therefore, if you reclaim and recapture and can set a higher low, classic Brigade bolt, right, there over the neckline of the pattern, great. Still bullish over 613, which is like I just mentioned on the daily. That's why I'm bullish here, right? Because you're over the neckline and you're doing this. If you're here, okay, now I'm back to neutral or even bearish, and I'm activating the short. I'm sort of initiating shorts, seeking shorts intraday if we're doing something like this into 601.65, right? Failing the shoulders of the inverted head and shoulders. Now let's come in here with some Fibonacci's and just check in from firstly the low. Oops, if we could get a click, there we are. Up to the high, it looks like we've overshot the 38.2, the 50, the 61.8 was coming into play at the low of Wednesday. This is why, again, in the intro, nasty overshoots out there. It is not like... Don't let the clarity of the charts in hindsight fool you about the real-time execution of these markets, right? It has been difficult out there to just flip-flop bias back and forth and back and forth and back and forth. You come into the 50 SMA, you're looking for the higher low, it doesn't happen, you overshoot, you're like, okay, I guess it's bearish, you're looking for a lower high underneath, to then suddenly not get the lower high, break out over it on Friday. It's a lot of mental gymnastics out there. It has not been easy, but the current configuration of the charts is as follows. If we can sustain this, bullish. If you want to try the pullback long off of 613, bullish. If you get this, I would start looking for bullish outcomes towards that pivot high on the daily. If you fail 613, bearish consolidation, initiating shorts underneath 607.50. Let's take a look over at the intraday anchored view apps and just see what else we can glean from this perspective. Above much more of the stack versus the S&P 500, the S&P had a little bit more, what would you say? They were distributed more evenly between the bottom of the stack and the top of the stack. You can see here from the breakout anchored view app that's just kind of holding us down like the S&P 500, which once again, if you do this, it aligns with the thesis such that over 618.50, you do get that lift. So that's probably the primary idea. If you're like, Matt, you can only choose one or two paths, I would be looking for this. That would be number one, and number two would be this. Why is this number two? Just because it doesn't really firm up our break of the neckline, excuse me. Right, it would be best structurally, right? What you want to see happen is previous resistance turn to newfound support. Let's prove 613 is going to be supportive. Let's go here, then let's get the Brigade bolt for higher. Right, that's it. All right, let's move on over to the NASDAQ internals, which you already got the sneak peek preview of. It looks good. Volume inflows, advanced decline line looks good, and we do have a positive slope on our cumulative build out of the tick. No need to hash out anything more than that. I mean, maybe we could just say that this is generally more bullish than the S&P 500, but it does have, right, with respect to this previous high, some more work to do. So you're really just getting back to on par with the S&P if you get here to then threaten the potential all-time high break. Maybe a little bit of a caveat we can give some credit to. Let's move on over to the final broad market index that we care about, at least. So much for old man Dow, but we will take a look at the small caps here. Russell 2000. Let's go to that weekly chart. Let's go ahead and throw on that 20 SMA. Thanks for bearing with me as we just reconfigure here. So on the weekly chart, structure I would say is more similar to the S&P, but it does have a slightly longer candle body than the S&P 500. And I would just say that's because the AI narrative, right, is somewhat, I would say, what drove the market there with MU rallying higher into the end of the week, even some recovery efforts, if you will, out of NVIDIA. That stuff much more influence in the S&P and the NASDAQ versus, of course, our IWM here, which is more Fed-dominated. Now, we did get decent inflation numbers, almost shockingly too good inflation numbers on Thursday morning. We'll talk more about that in the fundamental section of today's episode, but you can see here it's a potential pullback from the all-time high break. There's nothing wrong with this IWM chart here. The structure is bullish with the lower wick, although we did close in the midpoint of the range. Maybe a little bit of bearish pressure, but we're trying to make progress in the upward direction over a weekly 20 SMA. You could throw a Fibonacci on this from almost any perspective. You're over the Fib 38.2 if you come in from here, if you come in from this pullback low to the top, even if you come in from this up to this. Notice that you've held the 38.2. So all things considered, looks really good here on small caps in terms of its weekly structure. On the bar to bar count, just to be congruent, you do have a lower high as well as a lower low, but a close inside of the previous week's range. Ideally, you would like to get back over this previous pivot high, which as we know is closer to about 252s. Let's go to, what do we want? Let's try out the anchored view apps. Above the stack looks good from that perspective, and we'll also check out our high volume nodes just to see where we're at from this perspective here. And what we do want to do is just grab more than 3 years. Let's go out to a 10-year chart. Yeah, so we can take a look at this straight across the top end from these prior data points. Looks good. I mean, plenty of room for higher lows. I would say like monthly higher lows, monthly bull flag consolidation. Picture a monthly chart that looks like this, right? Pretend it's not even a weekly, pretend it's not even a monthly. What if I told you this was a 5-minute chart? Are you long or are you short there intraday on a bull flag? right? Probably bullish, right? Holding over previous resistance, newfound support, consolidation, break the highs. Let's see if we can rock and roll. So that's small caps in a nutshell there. Let's go on down to a daily chart for IWM and let's see what's going on from this perspective. Really sideways week, not much to write home about. So expected move first, as always, we've got 254.47 on the top swing and on the bottom swing, 247.11. A little bit more neutral here, all inside candles. Not doing much in terms of the range. I would say that this is bullish holds over the top end of what I would consider the bulk of the consolidation from in the past, and primarily this previous resistance over here, which is now acting as, with overshoot, a newfound support at 248.25. You can see how we're just kind of surfing the daily 20 SMA. That looks bullish to me, and of course, the next obvious configuration for this chart, or I should say development of this chart, would be this. A Brigade bolt back over the previous all-time high looks really good, turning previous resistance into newfound support again, looking for the all-time high. If we just consolidate in this range, I would say that this is fine digestion based on what we just talked about from the weekly perspective over the previous all-time highs. Not this, but literally the one from many moons ago. If we take a dive to the downside, this would become more concerning. I would start thinking about this through the lens of like, okay, why is the market doing this? If we have decent inflation numbers, again, we'll talk about cooked books in just a moment, and labor is seemingly deteriorating, or at least not as strong as we think, if we're going to have a supportive Fed, then like what's going on here? Small caps should technically be rallying. So I would assume we would need a data catalyst if we're going to get down here and start failing in a major way. And there's honestly not much in the way of catalysts until we really ease into the first full trading week of 2026, which is not the New Year's trading week. It's the week after that, of course. So there's almost like a 2-week lull where there's not going to be much in terms of catalysts, news flow, earnings certainly getting pushed out, and we'll talk more about that in just a moment. But let's take it on down to the hourly. Let's just double check and make sure we're all good here. Fairly straightforward, where I would say it's trying to look a little inverted head and shoulders-esque. You have a little bit of a break of a trendline neckline here. Acceptance over this previous area of support could act again supportive, and moves here start that daily configuration, which makes this more compelling in the first place. If you fail and you just start consolidating in here, not really interested in what that's doing for the broad market, and I would start saying, okay, it's going to act more as a headwind to the S&P 500 when and if we start dropping underneath that 248.25. So that'll be your key level to watch in terms of helpful or hurtful for the S&P. Let's take a look over at the internals for the Russell side of the equation, and what we can see over here is very similar to everything else. I would say maybe a bit more aligned with the bear side as we saw that inside consolidation, but generally speaking, volume flows, we're still technically in to the Russell. The advanced decline line ever so slightly negative here. The cumulative build, I'll give the sellers some credit there, but just kind of funky when you look at the actual movement of the Russell itself in the upward direction. So a little bit divergent on that front, but we know that, should we be thinking about the divergence being a main concern as the Russell just goes sideways? No. Right? If the Russell does this and the internals are blood red, then yeah, oh my God, red flag, don't trust that any further than you can throw it. But if the Russell's just grinding around sideways inside a consolidation range and you're divergent at the exchange, not really exchange, but index level from an internals perspective, then like, why are we concerned? Maybe it's a heads up that you're going to move through the lows, but like, I'm not initiating a short in the middle of the range because I think it's going to move through the lows. I'm just waiting patiently to say, okay, this is a headwind for the market, right? So divergence in a consolidation pattern doesn't really matter too much because you need the confirmation via price anyways. So that's my take, at least on small caps. Let's go on over to the, I just realized we did not look at the NASDAQ market profile, but you won't really learn anything different than what we talked about in the ES. So here's a little makeup for that. Value area exceeding the single prints from here. Poor high on the Friday session. Value area is clean and breakaway to the upside. Let's go on over to the Russell, though, just to make sure we can get the job done here. In terms of value inside of the consolidation, value is moving higher. So you might have a divergent and slightly more bearish market internals print on the cumulative tick, but what is value doing? It's actually shifting higher. Poor high happening here on the EFH periods on Friday, expecting a break through that to repair it. That would be the natural thing to happen from an auction perspective. Let's get back over to the platform here. Let's give this a little reset, and we'll work our way through our sector watch. What's going on? Who was leading, who was losing, and where was the weight? You could see that leading the pack was XLV this week, healthcare. That's technically a bit more defensive. Not overly concerned as of right now. You can see XLK just underneath it, up about 12 basis points. So all things considered, the market right itself, you could see is here, down about 75 basis points. Not bad. XLK up 12 basis. It's okay. It's all right. XLY is green on the list as well, so that's helpful. XLY is a risk-on sector. Bottom of the barrel is energy, real estate, utilities. as well as industrials in here. So I don't know about you, but that technically leans, a little bit more lightweight in terms of sector weighting, energy, utilities, real estate, and then utilities are just outright defensive. Right, defensive. Same thing here with consumer staples, down about 1.07%. So the lighter weight defensive names took the hit, while some of the heavier weight risk on stuff, and mind you, SMH is still down about 53 basis points on the week. Some of the heavier weight risk on stuff, mainly let's say XLK, XLY, was pulling its weight. Just it is what it is. It's pulling its weight. Have to overuse that term. Let's take a look through these structural charts though. Let's take a peek and see what's going on here. You can see that there's not much to talk about in healthcare. You're just in the midpoint of a range. And as we know, if you've been following along the channel, this is great weekly consolidation here over 150.25. As long as that's the case, my goal is to be scouting some sort of weekly cup and handle that could look like this, and then maybe the next break is in the upward direction. We have some new healthcare theme to pay attention to. As we also know, XBI, just to sort of stick on the theme of what's been doing well, XBI continues to look phenomenal. This is a weekly chart. Look at this high tight consolidation on the weekly. If we go to the daily, you'll basically see a nice flat top base building here, right? If we could go for like a low cheat setup over this, you might have another run in pharmaceuticals and biotechs and these healthcare names. You probably want to avoid the insurance name. Look no further than UNH. This is like horrible, but your pharmaceuticals, absolutely. Right? Talking about the Lillys of the world, talking about the Johnson & Johnsons of the world, talking about the Bristol Myers Squibb of the world, right? So that is the XLV. Let's go to the XLK. Not bad, still in range compression, very reminiscent, of course, of the QQQ. So I'd be paying attention to that, higher low as well as a lower high. What I will just say is there's a nice recapture of the daily 20 and the 50. It would be best if we could stay now over the top of the bearish engulfer high from back here, 1120. It's at 143.75. So early this week, consolidation above that starts to rally would be bullish. If we open on a gap up, that would be bullish. If we start to drop this area, okay, hang tight. Right now, all of a sudden, the narrative's kind of starting to get difficult again. So that's the XLK in a nutshell. If we jump into discretionary, what's going on over here? A little bit of a pullback from that all-time high break on Thursday, but this is exactly what we wanted to see. Remember how many times we talked about how equal these highs were? That's the improper end of the auction. This is the excess that's required to put in a more proper top or develop some sort of continuation. Right? I would probably lean into continuation first for the possibility of a Brigade bolt high or low over 121.25. If you drop that level, I would still keep an open mind to this off of the breakout point from here. That was at 119.85. All right, daily 20 SMA may catch up for confluence at that level some point this week. Let's jump into energy. Not much to really talk about over here. Crude continues to just get sloshed. Energy, if we take a look over at the CL, just really beat up. There's probably going to be a snapback trade at some point, and that's what I would put my thinking cap on for. When crude goes like this, what are the names going to be that we want to be trading? Is that XOM going to break out of its weekly massive base here? If I just do something like this, it's like one of the biggest bull flags in the market right now on the high time frame, right? Is XOM going to do that? Maybe. Is FANG going to continue on the daily chart to try to get back up and over this area here at 151s, let's call it, right? Is that going to take place? These are just ideas. It's not in play yet, but that's kind of what energy has me thinking about. If we look at real estate with rates coming up a little bit on Friday, a breakdown starting of this 7-month balance range, that's going to be pretty tough. If we start spending more time under 40-50, think about this through the lens of wealth effect, less through the lens of like sector weighting for the market. It's a lightweight sector. It's not going to drag the S&P itself, but as and if real estate values collapse, what does that mean for people and their perceived net worth? Oh, my home just got, I'm not saying homes will be cut in half, but let's just say your $1 million home goes to $750, and then maybe that's even a poor example. Let's say your median priced home, $400K, $450K, takes a hit, and now you're looking at $275, $325. What does that do for wealth effect? And again, it's very, very regional real estate. I'm just ideas about XLRE breaking down. That's what that makes me think of. So wealth effect could become in play for the S&P 500. We're not there yet. Certainly home values, with the lack of supply, I have not seen, at least regionally where I'm at, the two markets I follow, have not seen any major issues with that. If we go XLU, breakdown here, that's fine, lightweight sector. Nothing to do on that. Let's go XLI. Looks okay. Little overshoot to the moving average cluster. I'd like to see it get up and over 156 with acceptance before making a bold claim about continuation. For now, this kind of screams, head and shoulders threat. Here's your left, right? So something like that is possible. Have to break the neckline for me to say it's in play to the low end of the range, but just kind of hanging tight on industrials. XLP breaking down a little bit here. Still some of these like retail names have been doing good. XRT, if we can type, still looks good in a high tight flag here on XRT. You could go to your Macy's, you could go to your Kohl's, you could go to your Urban Outfitters, URBN, there we go. Still looks good, pulling back over 80, and I don't know, we'll throw a few more out there. AEO looking good here, continuing, and then what's the other one? AFO? What's American Eagle? Is this one? What's the other one? ANF, Abercrombie and Fitch, that's it. ANF still looks good here at the highs. So retail theme still doing well. Staples itself, though, pulling back, probably due to your cost of the world. Still getting beat up here on Costco. Walmart even looks okay, pulling back over a 20, building out a bull flag here, looks good. So little iffy on that XLP, and you could go to the Colgate Palmolive oils, of course. You could go to all that stuff too. XLF looks really good. Nice bull flag happening here. We know that the big banks really drove this move, and then we finally got some sympathy out of MasterCard and Visa. Look at these big pops here. Same thing on Visa, right? Big pop to the upside there. You could see the alert waiting. So with the sympathy happening, banks broke out earlier. Citi, here's Wells Fargo we've been talking about recently. These names still look really good, and for the XLF, it just means what? If this bull flag breaks out, what do we interpret for the S&P 500? The market's not going to crash if financials are making brand new all-time highs, right? It's that simple. So XLF looks fantastic as supporting evidence. SMH, what do we have over here? It's trying to hold over the engulfer highs after the nasty overshoot from Wednesday. I would give it the benefit of the doubt, right? That MU story we were just talking about, NVIDIA even getting a little bit of sympathy there on that Friday session. Broadcom trying to get a little bit of sympathy on that Friday session, although the chart still looks abysmal. So it's working on it. It's going to prevent the bear market, that's for sure, as long as we're over the moving average stack. If we can build this out and say higher lows, great. Weekly chart ascending triangle, we're not there yet, but we're making steps in the right direction. This would probably be next on the daily. Something like that. Let's go on over to communications. Still in a tight range here, watching this very closely. Let's take a peek over at the TLT. Long bond getting beat up a little bit. I still think the market's a little concerned about the inflation print, although we got a really strong read on Thursday. The market's kind of calling the bluff. I'll show you that on the ratio chart with the long bonds in just a second. If we look at the XLB, midpoint of the range, it's one of the lightest weight sectors. I'm not overly concerned. Let's take a peek through some supporting evidence over here. Let's jump into the ratio grids. If you're not familiar with the sector ratios, how to set this up, check out the video tutorial in the top right-hand corner. Still some concerns about lower highs here on the XLK, but we have seen the baton passed over to the XLF, the XLY, and even the XLC moving over the 50 SMA. So these top four are suggesting slightly more risk on. I'll go neutral tilde with an up arrow there. We do not have risk off, and we do not have risk off happening here. Let's jump into the specialized ratios. Let's go, oops, that's what we just loaded. Let's go A, there we are. Strides in the right direction, working on it, still needs work, still needs a lot of work here. So once again, neutral to bullish bias is what this is sort of suggesting to me. If we go to the B set, you can see that the gold ratio, small perk up on that Friday session into the end of the week. Bitcoin also catching a little bit of a bid off the lows, still though just in a bear flag configuration, and the Sailor Shift tool has not flipped in the upward direction. If we look at the TLT and the S&P ratio to it, you could see that risk appetite still remains elevated for equities. Let's take a peek over at the dollar and rates. Really not much movement. I would have expected a little bit more on the inflation print from the Thursday session there, a little bit more in the downward direction. You just didn't get that. So dollar lifting a little bit here, rates lifting a little bit here. The market kind of calling the bluff of the cold inflation print, which as we know, if we look at the inverted ZT, rate odds kind of unchanged in here. If we just jump on over to this Fed Watch tool, you could still see that we're dealing with about 75.6% chance of a pause in the next meeting, which of course is on January 28th. Little ways to go for that. If you take a look, you get 1 and 2 cuts still into the end of 2026, and that is about it. These odds are so flip-flop of a coin. I would just say the market's sort of projecting right around this 3.2, 3.1. Remember that the Fed SEP outlines a 3.4. So the market's saying no. We think that we'll get an additional rate cut still, which again, I think is supportive for the narrative that an accommodative Fed and an AI theme that comes back to life probably spells higher into the end of the year. Well, certainly the end of the year here, but also at early stages of 2026. No news on Monday, the 22nd. Prepare for durable goods orders. I wouldn't say there's anything too big to watch out for. Jobless claims, maybe. If we just look forward, once again, I would just show you this runway. There's a little bit of time. Let's get the click. There we go. There we go. There's really not much in the way of big data that's coming out. FOMC meeting minutes doesn't really matter, right? That's old news. Jobless claims is going to be the same thing Thursday or Wednesday with respect to the Thursday closure. If we go back a couple of segments, there we go. I just wanted to point out this 2.7 versus the forecast out of 3.1. Basically what they did is they said housing inflation is a big fat 0, and that's how we get a 2.7. So kind of interesting there. There's a lot of argument online about this right now. I don't think it really matters one way or another. It does seem like the goods inflation side of the equation. If you just take this, let's go on over here. Let's go latest release. And where do we want to scroll to? Let's go to the bottom. Sorry for the blurriness on your eyes, I'm sure. Let's go to detail. Let's just go expenditure category. There we go. So food, you're not going to be able to see it on the month over month, but if you look at the year over year, food's, pretty good. That's not really that bad at a 2.6 there. I'm generally just want to see goods. All items less food and energy. There you go, 2.6 as well. Right, so it is kind of in line there, and we know that the goods inflation was the issue. Services inflation based on tariffs is not really the argument. It's goods being imported, of course. You could say that it trickles over to services because then people have to spend more to get stuff, and then people want higher wages. I get it, right? But generally speaking, that's the idea there. So it's a matter of seeing the shelter number come down, and it always really remains about the shelter number coming down closer to that 2% to get what is really about 50-ish%. It's not quite half, but almost half of the inflation print coming from your shelter costs. So that's a quick overview of inflation. Again, even if this number is on cooked books, I think generally the move is to stabilize. And you might be like, well, prices are still high. Remember that inflation is the rate of change in the upward direction. So prices aren't going to come down. They're just going to stop going up. And I have sort of seen this anecdotally a little bit in my own life. I don't feel like that same exact squeeze is on as much. Not to say that it's not difficult for some folks out there and such. And the point's not to go too far down that road, but it does seem as though inflation is not the same 5%, 7% post-sickness. It seems like everything changed post-sickness, and now we are starting to stabilize a little bit more so. I don't know. That's my take, at least. And I'm not here to invite arguments in the comments section. That's just my observation. If you disagree, that's completely fine. Let's jump on over to the earnings calendar. There's really nothing to talk about here. This is the only thing that's going to report. I believe that's Lumen, if I'm not mistaken. And they are actually one of the trade ideas. So we'll get into that, but there's a block of no earnings, of course, through the holiday season. Then we'll pick it up into earnings season primarily on the week of the 12th. As we head into big banks. You can see them hiding out down here, starting with JP Morgan on the 13th, Wells Fargo, Bank of America, Citi, the whole 9 yards, Goldman, Morgan Stanley. We'll get into it. So there's a little bit of a free runway for the next couple of weeks, but as we know, it's the holiday season and we will have shortened markets. Let's jump back over to the platform here. In terms of people sort of making a bet against that government print, you can see here as this number and as this ratio continues to move in the upward direction, the long bond moving higher just tells us, right, that people are saying, no, we demand a higher rate because we believe inflation is going to be hotter than what you're telling us, right? That's why this ratio is moving higher and this one is going sideways. If we take a look over at the credit spreads, they're kind of unchanged this week. The longer end is slightly more elevated. I would say this is a small move in the upward direction, SHY, HYG. It's a proxy, and I would say unless this breaks to new highs, I don't necessarily think we're concerned on that front, I would say. HYG is suggesting a little bit of a bearish divergence if we go SPX down below. Notice how we have this clean. Let's get that. Why is that persisting? Show on hover. Okay. There we go. See how this has a lower low and this has a higher low? HYG is saying, nope, not yet. And there was this kind of odd gap down on HYG, in my view, having something to do with the OPEX. So we'll see if that can straighten itself up into the early stages of the week. But at face value, this is actually a bearish data point. This is telling us, no, do not trust that rally in the SPX. So if you're a bear, you want to lean into this data point quite a bit. Let's jump on over to breadth. As we can see, breadth here is pretty much stable all week, not really doing anything to get concerning. No moves under the 50% mark and no moves under the zero line here on new highs versus lows. If we go to a better view of the RSP up here, nice bull flag consolidation. It never really broke down on that aggressive day from Wednesday, and you could see it's very possible that from a bull flag breakout, you're just headed back to all-time highs. So breadth looks pretty good as well. If we go to the QQQE, the equal weight NASDAQ, you're starting to etch back into, or tried at least on Friday, this overhead range. It would be best if this could get here and break over the 104.50. Again, main point to illustrate is just the fact that it's not here. If we were here and the NASDAQ was sideways, great, screaming from the rooftops, oh my God, bearish divergence. We just don't have it. Let's jump into the VIX and see what's going on with vol getting absolutely crushed on that Friday session, and more importantly on the VVIX, volatility of volatility, making a substantial new lower low from pretty much all of this year outside of tariffs and what preceded tariffs. But that's a big break there on the VVIX, just telling you that nobody's reaching for insurance. Now, you could take the contrarian approach and say, okay, when nobody's protected, that's when the risk is the greatest for the largest move. That is technically true. Everybody would then start to reach for insurance, causing a bit of a spiral, right? That's where things get out of control. But you'd probably need some sort of catalyst for that. We just looked at the runway of the calendar, and there's really nothing. There's no earnings. There's no economic data. So what does it mean? It means you would have to get a black swan event. How do you prepare for a black swan? You literally can't, right? That's the nature of it being a black swan. You can't see it until you can actually see it. And there, by that point, it's already too late. So if you want to be contrarian, if you want to say, oh, I'm going to hedge against it, be my guest. But all of the supporting evidence we've seen so far today doesn't really suggest that that is going to be an overly lucrative idea. If you look at contango versus backwardation, huge contangos, we finally updated our charts here. Yes. So we have the updated futures contract rolled in there, as well as the 9 versus 30-day VIX, and even the 1-day VIX coming back down underneath that 1275. Once again, it doesn't seem like anybody is overly concerned with allocating capital at this point. The pullback, even that Wednesday breakdown, it hardly did anything to the contangos here. Look at the 9 versus 30-day. Nothing there. And the 1-day VIX, it creeped higher, but it did not make a new high. Nothing even close to that end of November move that we saw ahead of Thanksgiving. So with that, let's get back on over to the core list of companies, and let's finish this thing up on a strong note. What do we have with NVIDIA? Still caught between a rock and a hard place. When I say that, I'm talking about this box right here. Big failed breakout still on the weekly. It is possible that you can set and stage a lower high here. You're still underneath the daily 50 SMA, which is now curling in the downward direction. Now, NVIDIA is the one stock to rule them all. So is it possible that we need to start being a little bit more sympathetic to the recovery effort here and something along these lines? We don't have to do that until we actually see the break, but over 184.75, I would call it for what it is. A little bit of a double bottom over the neckline. Yeah, inherently it's bringing in a higher high. The daily trend is down. Lower highs happening here. You finally started to neutralize with an equal low rather than just lower lows. So you have this equal low. If you crack the last lower high, yeah, the daily trend is changing. So watching 184.75 most closely out of NVIDIA. If you take a look at the hourly chart, you could start to see how intraday on Friday, it was just up and away. Now, is this still just a counter trend move on the daily? It's still possible. It is still possible there. So I'm not overly enthused about executing NVIDIA in this box, but over 184.75 on a daily 50 SMA recapture, sure. That makes a little bit more sense to me. And NVIDIA has really been a back burner trade the last couple of weeks. Let's go to Apple and let's see what's happening here. Really interesting overshoot of the daily 50, but it is closing hammers back to back. Slight nuance of a potential higher low here. I don't love the chart in its current formation, and you saw this really odd OPEX volume. Let's take a look at the hourly chart. Look at this final hourly bar. Right, that's where a decent chunk of that additional volume comes in from. I mean, it's kind of a weird close, right? So it leaves a little bit to be desired for me in this box here, and I really want to start looking at Apple, on a longer term, maybe inverted head and shoulders. You build out consolidation here. The thin structure's over the neckline. So really and I will say this about the current environment of the market. The best opportunities have really been buying these things off of ascending moving averages. So Apple, in this case, should have been like a long on Thursday or Friday. And therefore, like waiting for this and then trying to get the breakout in the upward direction, that's not really the tone or the spirit right now of the market, right? Otherwise, it would have done it here. And it just didn't. So in my view, Apple, although I want to see that structure build out, I am mindful of the fact that it could just be too late at that point, and then it becomes difficult, right? What's a similar situation here? It's the same thing as Tesla, right? Tesla, much better as a swing trade after recapturing the moving averages here versus trying to day trade it in this, right? So similar idea, and we'll talk more about the nuance of Tesla in a moment, but that's Apple in a nutshell. The best entries may have actually already come. So that's what I've got there. Let's go to Microsoft. This one still looks good. And this is another example of buying things off of ascending moving averages here. Look at this. So I'm still long Microsoft, but just the spirit of the move, right? My average is in here. 480. 480 is roughly the average, right around in there. Anyways, the point of the exercise is as long as you're holding that ascending moving average and you're moving back into this through the lens of look below and fail, right? The time to buy this is not Microsoft trying to break out through the highs. It's trying to buy it as close as possible to the bottom end of the support range, right? So nice inside candle on Friday. I do like the consolidation here. I do like the the prospect of getting to the top of the balance at 493s. If you take a look at the hourly chart, still just a nice little bull flag here. You could look through this lens. So that is the top watch early on. If you start to fail this, we'll have to reassess under the 200, but for now, really nice overshoot to it, recapture the bottom end of the range, look below and fail, and now you're higher. So still working okay on Microsoft. I'd like to see it, of course, much higher, but that's just the nature of the beast so far. And I do like the hourly bull flag. Let's go to Amazon, another one. Great off the moving average here. Not so great on attempted breaks, back over this out of a 3-bar play. So not as fond. I would say Microsoft is a better looking chart than Amazon. Look at the upper wicks here, failing the moving average cluster. Underneath these lows would likely revisit these lows here. So under 224.85, probably talking about 221.50, and then a break through that. Quick trip to the 200 seems in store. If you can recapture more meaningfully 227, maybe there's something to do there. Take a look at this hourly chart. It's just so sloppy, right? Looks above, fails hard, tries again, comes back hard into the close to it. So 227 needs some better resolution. And honestly, I wouldn't call you crazy if you just put a box around these 2 days and said, I want to be here or I want to be here. That's it. That's all there is to really do on Amazon. Show me the resolution of that box, and then we have some targets to be looking for. So it leaves a bit to be desired. Google is one of the larger failures out there in the market, specifically on that Wednesday breakdown. It is starting to recover a little bit, but what's like the next idea for Google? It's pretty tough to try to buy this into overhead supply, in my view. A look below and fail on Wednesday's range Thursday would have been maybe an okay entry, but you just have an inside bar on Thursday. Leaves a bit to be desired. So this chart doesn't really strike me as being, a massive contender for a long. It definitely has relative strength, though, still to the broad market. It's just a matter of where do we go from here? How do you actually execute on the idea? I still am using 310.50 as a major inflection point. If we're over that, I start to become a little bit more optimistic about the upside lift. But once again, buying breakouts isn't really great here. You want to be positioned on lows. Let's take a peek over at Broadcom. This chart is still abysmal, although it did have a nice up day on Friday. You've basically just failed the all-time high break here. You failed back through this break, this higher low, failed. So really just seeking a lower high anywhere in the range keeps the pressure on. Maybe some sort of interaction with this gap below becomes an interesting trade thesis, but we're just not there yet. So you've gone counter trend. It's possible you're starting to build out a little bit of inverted head and shoulders on the low. Do we want to long into this high? Probably not. I would say that you want to see a Brigade Bolt Stevie Wonder here. If you're really fishing for a long, you could say A to B, but please, for all things market related that are holy, do not be long at point B retesting the 50 SMA from the low of the move. It's just asking for a lower high on the daily, as we just talked about, right? Big failure here, big failure here, clearly downside momentum post earnings. So this would be a nice lower high to configure some kind of reattempt at the bottom end of the range for a break into that gap close there. If it's going to be more constructive to the upside, if you want, you could say this, that then finds a higher low. That could start to become the move that establishes, no, this isn't going to break down, and rather it will rotate to the top end. That's a possibility, but I've got to see it to believe it. The momentum is clearly down. People are clearly selling Broadcom. I wouldn't fight that until there's some sort of more meaningful reversal upon us. Metaverse looks okay. I can start to see the opportunity here for cup and handle. It's a sharp cup nonetheless, but I could see it. Still a rejection at the moving averages, which I'm not too fond of. Meta has been a little bit of a difficult name to spot the actual trade on. I think until you resolve these moving averages, until you're either over, and I've been saying this for a while, but you got to be over 681.15 into the earnings gap, or I do think that this is a reasonable short underneath the consolidation lows at 637.50. If I could see this, I would actively participate in that short. We just haven't really gotten that, right? This did start to lift after this consolidation, and we know the XLC is kind of putting in that consolidation as well, not really breaking down. If we go on over to Tesla, Tesla is still looking bullish on the holds over this 470.75. Nice inside consolidation happening here. I would maintain a eyeball on Tesla for needs more sideways consolidation, builds out the range. All things considered, looks good. Bullish at the top, over the top, and then that is what we're looking for. Probably requires a catalyst. I don't know what that might be. Something about Tesla, something about Elon, something about full self-driving, robotaxi in Austin, expanding to other markets, other regions. That's probably what it's going to take. But for now, Tesla in its current configuration, bullish consolidation here looks good. Over the all-time high with catalyst, go with. Under, kind of skeptical of shorts in here. I would not be a big short on Tesla. Likely until we lose the 50 SMA, this bull flag here. Let's jump on over to JP Morgan. Not much to really do with this chart. We know that financials look good. Maybe there's a break here. It's not really a top contender. It hasn't really been moving with momentum recently. Big volatility, but not much momentum out of the actual range, And as we know, it's actually a laggard to its other banking counterparts like Citi, like Morgan Stanley, as well as Goldman Sachs. All of these have broken out, and of course, JPM has not. Let's keep going to Palantir. Let's take a peek over here. Really nice break on the Friday session. Just couldn't. A little frustrated with Palantir on Friday, but it did make the move. It made the move I was looking for, and 187.25 up and away right to the next resistance area here at the gap overhead. So for now, it's a bull flag breakout. You could get day 2 continuation early on Monday. Consolidation here looks really good. Brigade bolts into the overhead gap look really good. That's 195.25, closes at 201.70. If we pull back, the line in the sand is just this area here from the top end of the junk drawer back there at 187.25. As long as we're above that, we look good. And I would say that we're trying to work ourselves into a nice, neat little uptrend over the moving average stack. On the hourly chart, not much to really glean here. You could just kind of see this consolidation. It took all day, and then an end-of-day pop really sent it into that next overhead level. Once again, it would be fair for a pullback here, and it would also be fair for a daily pullback here that looks like that. Those are the two main theses on Palantir, or just straight up Brigade Bolt day 2 continuation into the, not earnings. Was it earnings? Let's take a peek. It was the earnings gap overhead, 195.25, 201.70. Let's keep going with AMD. Really impressive day to the upside on AMD. Was not quite expecting that given the inside consolidation doji on the Thursday session. It's looking a little bit weak with that close. Nonetheless, maybe a little bit of double bottom action happening here, but what do we know about double bottoms? You got to be over the neckline, just like the weekly double top, right? You have to be under the neckline here. You have to be over the neckline here. Nonetheless, that gives us 214.35. If we can get back above that bullish consolidation, as long as it holds lows, possible higher lows, double bottom, little flag on the right side, can we get that? Like, that's the next bullish opportunity on AMD. If it fails here, then what else do we have? Just descending triangle is a bear flag off the highs, and then the gap becomes really compelling to the to the downside. So the best trades, in my view, on AMD will be under 196.75 or over 226.65. Those two inflection points are the next big trades on AMD. Anything in between, you might be able to pick off some intraday stuff on it, but I would say that it's kind of just noise for now. Let's take a look at Robinhood. What's going on with the hood? Looks like a bear flag to me underneath the moving average stack. Really weak, really undecided look at 120.50. If you take a peek on the hourly chart, look at how it tries to hold above, it fails. It tries to hold above, it fails. It tries to hold above, it comes into the close. Leaves a lot to be desired on Robinhood. There's your range over 124.75, under 114, but in the context of its current configuration, I would be a little bit more bearish on Robinhood. I know that's counter to my thesis on the broad market, but Hood just looks kind of like it's struggling here. You had all the opportunity in the world for bull flag consolidation, even a higher low, and then go. You just failed miserably at the daily 50, at the 20. None of that stuff really held. So in my view, a little bit more pessimistic, skeptical of Robinhood putting in a big reversal. That's it for the core list. That means we've got additional ideas to get through. The first one's going to be on the energy theme. Let's go BE, Bloom Energy. Bloom Energy could be interesting on a look below and fail. Look below and fail of the daily head and shoulders neckline. Left head, right shoulder. Looked below, very similar to here, failed if we can get over 90. If we get over 90, I think this recapture here, recapture, will start to look good into the moving averages, could start to establish really tight risk for a long back up towards the top if you believe it's just going to rotate through this range here. So BE looks pretty good. If, again, we can retake 90, you got yourself the inverted head and shoulders intraday. Show me the move over 90, $100.50. I mean, that's more than a 10% move, right? The average range on this BE is quite wide. As a matter of fact, we could just throw this on here. Let's go ATR. Let me get my little custom label. A 12% ATR. Come on, right? That's huge. So watching that very closely, and we'll see if this wants to make the move to the 20. That's BE, first of many energy names. Next is CEG in the same sphere. This one doesn't look as good, but you sort of have a very well-defined range, and therefore, if BE catches a bid, if all these names in the energy front start to catch a bid, I could see something over 379 towards these highs. That would be up there at 407s, let's just call it for round number sake. Let's try that, 407. That looks pretty darn good. Right, there you go. So 379s. Can we get this on CEG? 5% average range. Let's go on over to the sort of old granddad of them, GEV. GE Vernova. Just to sort of stay thematically on par with what we're talking about here. If this can take out 665.75, at least the opening print of the breakdown bar from Wednesday, that would be here, 688.25, right? That's not a bad look there. If not the closing high, that's a high volume close up there at 723.25, we'll say. That's good enough for me. So something along these lines, if this energy theme is going to come back into play. That's the big question. Is it going to come back into play? We'll have to see what catalysts look like in the headlines on the early stages of this week. And expectations should be pretty low. I'm not looking at these saying it's got to get there. It's just got to do it. It's the shortened holiday trading week. The market can do whatever it wants to do. Right, it's okay. So that's GEV and the energy complex there. Let's go IREN. Speaking of data centers, this is an idea for a very similar look. However, instead of look below and fail, I would argue that if this is going to become troublesome, you just have a lower high, right? You have a lower high underneath this. The true time for a look below and fail would have been right around in here, right? Look below the double top neckline, fail back above, sellers fail, then rotate there. That's just never happened, right? So as of right now, I'm a little bit more partial to, do we set a lower high at 39.80? So if you want bullish, AI theme energy, go with those BE, CEG, GEVs of the world. If you want bearish and you see the headlines to back it, go IREN data center here, lower high underneath this overhead supply, right? Something like 39.80 and then rejecting back down into this 34.50. All right, that is the IREN chart. Let's go MU, which we already talked about briefly, but I do think it could seek some sort of day 2 continuation after a close at brand new record highs. Any pullbacks that consolidate over the previous all-time high in here at 260.55 look really good. Attempted that for a little scalp intraday on the Friday session and, worked okay. But for now, a better hourly higher low off of it sustains the move higher. You could also just say something like over 268 would be a breakout into new highs if we open in range. If we gap up to new highs, gap fill reversal, or a move over the overnight high with a Brigade bolt intraday is how we might get involved in that. That is MU as an additional idea. Next, we have Netflix. Netflix is still in a bear flag configuration. The chart looks absolutely horrible. Look at these upper wicks, rejection, rejection, rejection. If we sweep these lows, looking for lower, still looks like it could easily come back down to that 85.50. And here it is on the hourly, just not really getting any love. No love off the previous day high, closing week in the midpoint. Looks a bit more bearish to me than bullish. That's Netflix as a daily bear flag with some room to fall into 85.50. And then finally, we'll take a look at the space complex. Rocket Lab is going to be up first. You can clearly see massive push in the upward direction coming into these equal highs. Now, I'm not an advocate for just blindly buying this into resistance, of course, but I think that noting the momentum here, noting the big catalyst, right? It has to do with the brain fart. Executive orders and support for potentially space exploration and such. So Rocket Lab over 64.15 on a pullback here, not bad, right? Something like that is pretty darn good, right? So that's what I'm looking for. Does this pull back? Does it set up a new higher low? Does it set up a high tight flag? Does it set up some sort of cup and handle over time? Do we go sideways here for a month and then break out? That's a possibility. I'd say ASTS does not look as good. You did not clear these highs. You're not coming into the prior all-time high. It's still breaking out for sure, but it's not nearly as good. And then LUMN looks pretty good. Sorry, not Lumen Technologies, but rather LUNR. LUNR, my apologies on that. There we go. Over 14 is a break of this multi-week balance range over here. Does this start to step up over 14 and get some acceptance higher? Again, not an advocate for just chasing it smack on the highs, but definitely a stock to watch. Huge high volume coming into it. These are names, particularly Rocket Lab, LUNR, and I'd say PL is another one that can play, Planet Labs. These price points and options chains say, do not touch options here. You want to just be trading straight shares. And straight shares have not been the worst thing in the world recently, noting that you sort of dodged some of the theta decay, which was particularly bad while we were in that S&P balance range for a number of days back here. So anyways, back to PL as a potential idea. This chart, as it sort of, if it can stick up and over the close here, something over 1920s, that looks pretty good. That looks pretty good as PL may put in some tightness and then go again. We'll see. But for now, holding the gap up, nice consolidation, easy higher low here. Still watching PLs of the world, Rocket Labs of the world, Lunars of the world, and that's it. I know that was more than 6 individual charts, but it's 6 themes. We have energy, IREN, MU, Netflix, Rocket Lab. Is that? Yeah, no, that's 5. That's 5 themes with many, many subcomponents. All right, you get the idea. That's going to do it for today's episode and installation of the weekly watch list. that is it for today's episode. If you learned something new or enjoyed the episode, do me a favor, drop a comment down below, let me know what it is, or just give the video a very simple thumbs up. Do all the YouTube stuff, hit the buttons, and of course, we'll be live up here in the office every day at 8 o'clock for this week's episodes of the pre-market prep. We'll build some game plans in real time as the market is scheduled to open up, and we'll go from there. Obviously, we have a shortened holiday week, so a Merry Christmas, and we also have a half day on Wednesday, full session on Friday. Christmas is on Thursday, right? So be prepared for a half day Wednesday, nothing on Thursday for Christmas, and then on Friday, the market will technically be open, although you can almost guarantee not many people will be trading. So we'll see if we're up here in the office or not, but that is what we've got this week. Once again, if I don't see you between now and whenever, Merry Christmas, Happy Holidays, Happy New Year, all the good stuff. I wish you nothing but a prosperous 2026. And with that, have a green trading week, and I will see you in the next one.